Selling a lower middle market California business without a strict strategic framework is a dangerous trap. Owners often enter the market unprepared, assuming a lifetime of hard work guarantees a smooth transition, only to watch their deals completely collapse during buyer scrutiny. The stakes are incredibly high. California business owners who go into negotiations blind routinely risk losing up to 40% of their life's work and total company value to entirely preventable operational and tax mistakes. To prevent that loss, you need to build and execute a custom, actionable 18-month strategic exit roadmap. This timeline gives you the necessary buffer to optimize your operations and properly position your company before you ever meet a buyer. Before you can start this roadmap, you have to gather your materials. Pull together your last 3 years of financial statements, tax returns, and operational metrics. This raw data is the foundation of your exit strategy. By utilizing an 18-month roadmap and organizing your financials early, you replace a chaotic, highly emotional sales process with a calculated, maximum value transition of your wealth. Step 1 begins in month 1. Hire a mergers and acquisitions advisor. Specifically, you need an advisor specializing in the California lower middle market, handling businesses with $2 to $50 million in annual revenue. These professionals typically increase your final sale proceeds by 15 to 30%. They achieve this by directly accessing confidential networks of qualified buyers and managing the complex regulatory requirements specific to California. Your advisor's first major task is establishing a strict baseline valuation for your company. They will determine exactly what your business is worth using 3 distinct mathematical methods. The income method determines worth based on projected cash flows. The market method compares your business to recently sold companies, calculating a value of 3 to 6 times your EBITDA, your operational profitability. Finally, the asset method totals raw values of equipment, property, and inventory. Establishing this strict mathematical baseline keeps you anchored to reality. It prevents you from overpricing the business based on emotional attachment and instantly filters out unserious buyers who are hunting for steep discounts. This cleanup phase boosts baseline valuation by 20 to 40%. First, document operating procedures. Second, diversify your customer base. Third, upgrade to formal monthly accounting reports. Fourth, resolve any legal liabilities. Fifth, clean the balance sheet by removing all personal expenses. This checklist directly increases your final sale price, while systematically removing the financial and operational red flags that trigger deal failures during due diligence. Now we will look at deal structure. How your business is sold dictates your actual take-home pay just as much as the final negotiated price tag. An asset sale gives buyers depreciation, but penalizes sellers with ordinary income taxes and retained liabilities. A stock sale protects sellers with capital gains and transfers liabilities to buyers. Beware, California's 13.3% high earner tax can completely decimate your final payout if structured improperly. Securing the correct deal structure with a specialized California tax advisor early in the process preserves vastly more of your wealth than fighting for a slightly higher top-line purchase price. With your operations optimized and your tax strategy set, you enter the final 6-month stretch, taking your business to market through the 5 formal phases of M&A. Phase 1 is preparation. You will compile your cleaned-up records into a comprehensive data room. Finalizing this documentation now prevents the fatal mistake of sloppy bookkeeping derailing buyer confidence later. Phase 2 is marketing. Your M&A advisor initiates a 30 to 60-day period of highly confidential outreach, targeting qualified financial and strategic buyers without disrupting your daily business. Phase 3 is negotiation. You will receive initial offers, but you should never accept the first letter of intent. A letter of intent is a preliminary commitment to buy your business. Instead, let your advisor use multiple offers to force competitive tension and drive up the final terms. Phase 4 is due diligence. This is a grueling 60 to 90-day period of absolute buyer scrutiny. They will verify every financial claim, review every customer contract, and conduct on-site visits to ensure the business performs exactly as advertised. Phase 5 is closing. The final 30 to 45 days are spent executing formal purchase agreements, completing specific California regulatory disclosures, and arranging the final distribution of funds. Strictly adhering to these sequential phases ensures you remain in total control of the timeline. It prevents the desperate, last-minute concessions that plague sellers who rush to the finish line unprepared. This 18-month timeline maps out the complete roadmap you've just built. You now possess a fortified operation, a strict mathematical valuation, a tax-optimized deal structure, and a battle-tested plan to navigate the transaction phases. Your immediate action item for today starts outside the business. You need to initiate your personal financial planning before you ever contact a buyer or pull your first financial report. You must calculate exactly how much money you will need to maintain your desired lifestyle after the sale. Defining this exact target number allows you to evaluate incoming offers with cold logic rather than reacting out of emotional attachment to the company. Executing a successful exit means purposefully funding the total financial freedom of your next chapter. Look in the description below to download our complete due diligence checklist and begin organizing your data room right now.